Welcome back to 7-Minute Options. Today we're going to talk a little bit more about IV and IVR and why it's so important when you're selling options. So if I look at any options table, in this case the SPY or the SPY, the spiders, on the right side here you can see implied volatility. If I look at the June 18th expiration, it's around 21%-ish. And what that means is, roughly mathematically speaking, based on what people are paying for options today, this is the IV that we get when we plug options pricing back into the Black-Scholes formula. Don't worry too much about the Black-Scholes formula. It's just a mathematical explanation, or model, maybe is the best word. It's a mathematical model for how options pricing works. And it's surprisingly accurate. That being said, it's the market that determines IV. So people have a good idea of how much they're willing to pay for insurance, right? Options are essentially insurance. So if you are absolutely convinced that there is a stock market crash tomorrow, then you're going to pay a lot of money for those puts, or for options in general, to protect you. If you don't think a stock market crash is coming in the next couple of months because, hey, the Fed's going to bail us out and interest rates are going to be low and all that good stuff, if you don't think a stock market crash is coming, then you're not going to pay a lot of money for options in SPY, right? And so this IV number represents the market sentiment for just how much risk the market perceives there to be. And the IV is quite important, but even more important is the IV going to increase next month or decrease next month or next year or whatever? Like, how does this IV compare to previous and future IVs on this underlying? And so people have come up with two different methodologies. One is the IV rank, one is the IV percentile. They're very similar. Tastyworks here likes to use IVR. It's easy to calculate. What IVR does is it looks at what was this value over the last 12 months, the highest value and the lowest value that this underlying had over the past 12 months. And then it says, okay, today, this is where it is relative to the last 12 months. So an IV rank of 18 right now, that tells you that roughly 18% of the time in the past 12 months, the SPY was less volatile than it is today. And if I look at it graphically, you can kind of see here, right? Back in October, if I'm looking at here, there was a spike in volatility. And then in January, there was a spike in volatility. And actually right now, over the past week or so, there's been a spike in volatility. It's actually come down a little bit, but it's still higher than it's been in the last 6 months or so. Now, remember, options pricing is based on volatility, or in this case, implied volatility. And so you want to sell options when the IV or the IVR is high because you're expecting the IV to fall, right? If you sell when the IV is high, when people are paying a lot of money for insurance, and then if all of a sudden a lot of that fear goes away, volatility goes down, then you can sell it for a lower amount. You can buy it back for a lower amount more quickly, right? So you actually start to earn money more quickly, right? Another way to think about it is because it's typically insurance. If the stock tends to go up very quickly, then, or just tends to go up in general, you'll see that the implied volatility drops, right? So when you see the SPY rising, then the implied volatility tends to drop because people don't feel that insecure about the SPY. They don't want to buy insurance against the SPY because the SPY is going up. Times are good. It's when SPY starts to drop quickly or SPY gets a little bit choppy, that's when people start to get a little bit nervous and they want to go out there and buy insurance. And so quite often, if you see this spike in volatility here, it matches this rapid drop, right? SPY had 3 losing days out of 4 and people got a little bit nervous. When you see this spike in volatility here, you can see SPY had 5 losing days in 6 sessions. There you go. So volatility spiked a little bit. And of course, the bigger the drop in SPY, the bigger the drop in volatility. Actually, now we've come out of it. You can see back last year in June, we were also quite high, right? This was just 2 or 3 months after the COVID crash there. Volatility was still high. And then people started to relax over the summer as SPY kept going up and up and up. But generally speaking, and this is true for all stocks that you want to sell options against, or all ETFs rather, you want to sell when IV is fairly high and buy back when it's a bit lower, or when time premium has worked in your favor. Now, typically speaking, most of the time, if IV rank is above 20 or 25, it's usually safe enough to sell. But if you guys recall, let's take a look at X, for example. If you guys recall, yesterday I opened up, 2 days ago, I opened a position in X, in US Steel, right? And I didn't really talk about IVR at the time. Remember, these are only 7-minute videos. But if I look at the graph for X, for US Steel, you can see that here's the IVR. US Steel had a bit of a rough stretch. It had 9 losing sessions in a row, and volatility spiked, and then it stabilized, and then it went up quickly. As it went up, IV went down, and look, right as we start to hit a few losing sessions, volatility spiked, and that's when I sold the option, right there. What I did is I drew these lines in. This line represents the day I sold the option. This line represents the day it's going to expire, the expiration date, and this line here is the actual line. It's a $22 put, right? So I want this to stay above this line before I reach this. And I might close it out a few days early, maybe 5 days early, maybe 10 days early if I made most of the money. I actually don't like to hold options until expiration. If you listen to Tastyworks or Option Alpha, they're the same. They advise getting out of it before expiration, maybe 5, 10, sometimes 15 days before, and we'll get to that in a future episode. But I just wanted to show you that, yes, there was a reason why I sold this 2 days ago. The IV was a little bit high. It's at 26 IVR. Still today, it's at 26 IVR. And as the IVR comes down a little bit, I actually got more money for this option than had I sold it down here. All right. Wow, that's 7 minutes. Thanks, guys.